All right, welcome to Talk Tickers. So Fannie Mae just dropped its Q4 numbers, and on the surface, it looks like a record-breaking year. But here's the thing, the stock basically did nothing. It just sat there. So we're going to dig into the earnings call and figure out what's going on. Why is the market so skeptical, and what does it mean for the stock going forward? Okay, here's how we're going to break this down for you. We'll kick things off with the big numbers from the quarter. Then we'll look at the good news, the bull case, and the not-so-good news, the bear case. After that, I'll give you our official rating on the stock for the next quarter, and we'll wrap it all up with a pretty interesting trade idea. All right, first up, the Q4 results at a glance. And let me tell you, it's a bit of a mixed signal. So if you just look at the numbers, things seem pretty stable. Net revenues were about $7.3 billion, which is basically flat from last quarter. Net income? A really solid $3.5 billion for Q4. That brings the grand total for the entire year to over $14 billion. I mean, on the surface, that looks like a pretty durable, profitable quarter, right? But the number that really jumped off the page, the real headline grabber, was this one, $109 billion. That's Fannie Mae's new record for net worth. And believe me, this is the absolute centerpiece of management's story. They're basically saying, look at this fortress of a balance sheet we've built. And it's all thanks to 14 straight years of being profitable. Now, you see a number like that, a record net worth, and you'd think the stock would pop, right? You'd expect some fireworks. Well, nope. The market just kind of shrugged. The stock closed up less than 0.5%, barely moved. And that is the big puzzle we need to solve today. Why the massive disconnect? Why did the market just not care about this record-breaking capital position? Okay, to figure that out, let's start with the good news. Let's look at the bull case, which is exactly the story that management is pushing. And honestly, it's a pretty compelling story. It's all about financial strength and really tight operational discipline. The CEO really hammered home this idea of durability. The core message was, hey, our main business, this guarantee fee engine, it's a reliable moneymaker. It's consistently profitable, and it lets us just keep stacking up capital year after year, reinforcing their whole position in the housing market. And it wasn't just talk. Management brought the receipts, showing just how disciplined they've been with expenses. They cut their workforce by around 1,200 people. They scaled back spending on contractors. They even went back and renegotiated key contracts and shrunk their real estate footprint. I mean, these are real, concrete actions that directly help the bottom line. Okay, so that's the bull case. It sounds great, but the market isn't just listening to that story. It's also seeing the other side of the coin, the bear case. And this one is all about one thing, potential cracks in their credit quality. So this is the question that's really hanging over the stock. That fortress-like balance sheet is awesome, but is it just masking a growing problem in the loan book itself? Are there cracks starting to appear underneath the surface? Well, if you look at the data, the answer seems to be, yeah, kinda. The serious delinquency rates are ticking up. Look at single family, up to 0.58%, and multifamily is up to 0.74%. Now, these aren't panic button numbers, not yet, but the trend is undeniable and it's going in the wrong direction. And hey, don't just take my word for it. This isn't just us reading the tea leaves. Management came right out and said it on the call. They gave a clear warning saying, and I'm paraphrasing here, that they believe multifamily delinquencies could keep climbing in 2026. Look, when a company's own leadership team warns you about future credit problems, you absolutely have to pay attention. So here's where we are. We've got two completely different stories. On one side, you have this incredible capital building machine. On the other, you have a flashing red light on credit. So how do you put those two together? Well, that brings us to our take on the whole thing, our rating for the next call. As we look ahead, there are three major headwinds we're keeping a close eye on for 2026. First, and this is the big one, what happens with that multifamily stress? How bad does it get? Second, you've got pricing pressure in the single-family business. And third, the wild card that's always there, interest rate volatility. These three things are really going to shape how the stock performs. So when we weigh everything, the good and the bad, we're landing on a rating of market perform. And our thinking here is pretty simple. That capital generation story, it's powerful, it's real, and it's compelling. No doubt about it. But we think it's now completely canceled out by the very real forward-looking credit risk, especially in that multifamily book. So the bull case and the bear case are basically in a tug of war. And for now, it's a draw. That's why we're neutral. So you might be asking, how do you even trade a neutral reading? Great question. And that brings us to our last section, the trade idea.
For this part, I want you to imagine we're in a hedge fund and I'm pitching this idea to the investment committee. It's a little bit out there, but totally plausible.
Okay, the strategy is what's called a pairs trade. If you're not familiar, it's pretty straightforward. You buy one stock, that's your long, and you short another related stock. The whole point is to make money on the difference in how they perform, not on which way the whole market goes. It's about relative value. And check this out, because this chart really tells the whole story. Over the last month, the entire financial sector, we're using the XLF ETF as a proxy here, is down about 5%. Not great, but not terrible. But Fannie Mae, it's gotten crushed, down over 28%. That huge gap, that massive underperformance, tells you the market is already sensing that there's a problem here that's specific to Fannie Mae.
So here's the trade. You go long the financial sector ETF, XLF, and you short Fannie Mae, FNMA. What does this do? Well, first, you get exposure to the general stability of the financial sector. Second, you isolate and basically place a bet against Fannie Mae's specific credit problems. And third, you're now set up to make money if that performance gap we just saw gets even wider, which we think it will as these multifamily issues get worse.
And that leaves us with one final big question to think about. We've already seen this huge underperformance, but what happens as the market starts to really price in a worsening credit story for Fannie Mae? Will this slide accelerate? We think it might. And that, right there, is the entire thesis behind this trade.
This is not financial advice.